Good afternoon, everyone. I'm Robert Doar, the president of AEI, and I am very happy to gather us all today, this afternoon, for a discussion of ESG, ending ESG, and restoring the economic enlightenment by our great friend Phil Gramm and our also great friend but newer friend, Terrence Keeley, Terry Keeley. I think both of these gentlemen are known to many of you, but I'll just say a couple things. Certainly, first, Senator Gramm is an economist by training. He taught at Texas A&M for years. He was a congressman. He was a member of the United States Senate who passed important landmark legislation. He has been the most, I think, compelling spokesman for free markets and free people on the editorial op-ed page of the Wall Street Journal for many years.
God bless you, thank you.
And he's also an AEI scholar, which, of course, that's the best thing about him. And he's the husband of Wendy, who we love as well. Terry Keeley is a business associate of Phil's over the years at UBS and at BlackRock as well, and has been a participant in public debates about these issues concerning finance and equity markets, and is also, of course, the co-author with Phil of this collection of essays on ESG and what's wrong with it and why it's harmful to Americans, to investors, and to our economy. And so I want to just start as a primer with you, Terry. What is it and where did it come from?
Well, that's probably the right place to start, Robert. Again, pleasure to be here. Great to be with my friend Phil, who is very, very special to me. Great that we collaborated on this project, and thank you for all the support at AEI for the book, Robert, from your team. ESG, sort of born out of whole cloth, to be quite honest. The best way to understand, there's no way to explain the emergence of environmental, social, and governance phenomenon without understanding the role that the United Nations has played in it. The United Nations, actually, the real birthing of ESG came in 2005, 2006, when Kofi Annan asked a group of financiers to come up with a list of investment principles that would somehow help promote the millennial sustainable development goals, the millennial development goals, and sustainable development goals. And out of that came the United Nations Principles for Responsible Investing, UNPRI. In fact, Kofi Annan launched them in April 2005 at the New York Stock Exchange, ringing the bell. But of course, it makes no sense to even start there. You have to go further back. Where did those millennial sustainable development goals come from? Why was the United Nations itself even involved in a debate on what should finance be doing to create a world of greater, of not only abundance, but social and environmental outcomes? And that really traces itself to 1948, Robert, to the United Nations Declaration of Universal Declaration of Human Rights. So you really have to look at that whole tracing. And during the 80s and the 90s, there was so much economic progress that the United Nations started thinking to itself, what else can we do for education? What else can we do for women's rights? What else can we do for any number of other social and environmental causes that they started thinking was it? And that's the UNPRI. The UNPRI came up with a list of, it's in our book, it's in the first chapter. And the first chapter, I think, Phil, you would agree, is sort of a history of ESG, probably the best thing that you can read on that topic that's quick and easy. And ultimately, the 16 different categories of environmental, social, and governance priorities were listed as material risks. And then, of course, what happens next, we have all sorts of regulatory outreach and all sorts of financial innovation.
And so, Phil, you and I both know one of the great things about you is that even though you spent all those years in the United States Congress, you know that America is much bigger than politics and policy. There's this amazing economy of people creating wealth and creating jobs and working every day in everyday jobs and businesses that really is the engine of our society. Why is this doing good stuff bad for that and contrary to a long-standing belief in shareholders' outcomes and the Western tradition?
Well, let me first say that we have a lot of living memory about Marxism. There are enough people in the world that suffered from it that we have a certain degree of immunity. But we have no immunity to the socialism of the Middle Ages. And the reality is, as new as this idea sounds of forcing, encouraging, mandating that private investments serve public purpose, that wealth not just serve its owners, but society, that's right out of the Middle Ages, and a total violation of everything the Enlightenment was about. In the Middle Ages, workers had fealty to the king, to the church, to the village, to the guild, and they all had become these leeching forces that leached out the incentive to work and to save. And as a result, for 1,000 years, from the fall of the Roman Empire until the Enlightenment, there was virtually no economic growth in the world. And then suddenly in the Enlightenment, the idea arose that people had a right to think their own thoughts, to worship God in the way they chose, and to benefit from their labor and their thrift. And that was a new and revolutionary idea. As Adam Smith put it in a quote that's on his grave, people's right in their property of their labor is the fundamental basis of all property rights. In other words, the idea of the Enlightenment was that labor and thrift were private property. That unleashed this incentive that if you look at world GDP and you plot it from 1,000 to the present, it goes along without changing any perceivable amount except around things like the Black Death, where you had large falls in labor force. And then all of a sudden, with the Enlightenment and the Industrial Revolution, and it was the self-interest of people in advancing themselves that set off this explosion in growth that did more for mankind than all the benevolent kings, the loving bishops, the towns, the guilds.
But it did more for mankind in raising people's standard of living and reducing poverty and increasing human flourishing.
And expanding
promoting
freedom.
Education, creating organizations like this and universities. It created the world that we live in.
And now, ESG...
Which is a lot of good, by the way.
Yeah, exactly. ESG is an assault on all that by saying that that private investment should serve not the people that invested, but should serve the public interest, though these stakeholders have not staked anything in the company. And that's the fundamental assault that we are trying to answer in this book, and basically noting that that is an assault on the basis of American.
And Robert, maybe I just add
Yes.
two things to that. Some of that wealth achievement is very recent. In 1980, 1 person out of 2 in the globe lived on less than $1.91 a day, lived below the poverty level. That today is 1 out of 10. So a lot of the stress that we see on our various ecosystems is a result of a huge amount of human progress that has been made just since in the last 50 years. And of course, with wealth comes better health outcomes. With wealth comes less damage to the environment. You actually want to live cleaner, get wealthier. The wealthiest countries in the world have the cleanest energy mixes, unsurprisingly.
So, Terry, where do these pressures to force companies to take into account outcomes in the climate or outcomes in social justice or have governance policies that feed a diversity, equity, and inclusion mantra.
Yeah.
Where do those pressures come to bear? Do they come to bear in the corporate boardroom, at asset managers, and also at SEC? So just take us through one or two of those, and maybe, Phil, you can talk about the SEC, but tell us how that actually works on a company.
Yeah, so the pressures that have grown, Robert, just I would say in the last decade, have been the result of a growing cabal of saying, well, let's solve all these other social issues that we have not addressed, be they environmental or social. So you pick diversity as an example. It was effectively asserted through the ESG movement that somehow a company that had a more diverse board would perform better, would be better for shareholders, would be better for society. These assertions were made unlike typical financial engineering. Typically, when you're going to test a financial hypothesis, you say, well, we want to maximize discounted cash flows, we want to maximize profitability. What are the things that lead to greatest profitability? And let's invest in companies that are following those precepts. ESG turned that on its head. We assumed that any company that had higher carbon emissions was somehow going to be a worse company, a bad company, a company that you wouldn't want to invest in because they have emissions. So that got translated into these trillions of dollars, and I'm sure we'll get into some aspect, There are today nearly $40 trillion worth of ESG products out there that are investing in accordance with these ideas. Lower carbon emissions, greater diversity. Then you actually look at the data. Well, the data has shown that those strategies are not alpha generating. Very specifically, the studies that are coming out now, if you really want to ruin a company, diversify your board. The actual impact of board diversification has been negative in terms of alpha generation. Those firms are underperforming those with less diverse boards. So that's just a surprise. So you say, what has been the transmission mechanism?
Yes.
Well, the transmission mechanism has been a series of pretty loudmouth individuals, some with not very much capital. Arjuna Capital is the one that's being sued right now by ExxonMobil. They buy a few shares, and they propose these various shareholder resolutions. And then these shareholder resolutions, which have grown in number, they tripled between 2019 and 2022. We've had peak ESG. Let's be honest. I think you wanted to talk a little bit about that.
Yeah, I'll get to that in a minute, but keep going.
Everybody wanted into the swimming pool. There must be something to this ESG thing. There must be something about environmental, social, and governance causes that are alpha generating. Let's design products, investment products. Let's go and follow this thesis, even though it had not been tested.
Okay, before I come to you about the SEC and government and Senator Warren, I just want to stick with you one more time. Isn't there also, in this audience, there are people here who may have been some sort of EFT or that's managed by fund managers. And they have no real say in how their fund managers vote shares or talk to the corporation about their direction. Tell us, explain that dilemma where they're violating a long-standing principle of law that fund managers must express the best interest of the shareholder in their fiduciary responsibility. Am I right about that? And what's the status of that?
One of the great financial innovations of the last, let's say, 10, 15 years was the result of Jack Bogle of Vanguard, which is that you can index products. And you can actually create those products very, very cheaply for 1-2 basis points. We have democratized finance, Robert, by making those various ETFs, which is, I think, what you were talking about, or other index funds available very, very cheaply. Show of hands, who has a Vanguard fund in there? Who has a BlackRock fund? Who has well done, thank you very much, Taylor. A friend of mine who's come in from out of town and he still reports BlackRock. The truth of the matter is, what ended up happening is as the top 3 accumulated assets, of course, nobody in the room votes their own shares. They're being voted on behalf. And some, this is where Senator and I have sometimes said, I believe there's good intentions behind this. I genuinely believe, Larry Fink's a friend of mine, I genuinely believe that he believed that we needed to do net zero, that if there were greater diversity, these would be good. And so the shares started being voted in this way. And shareholder resolutions, particularly in 20, 21, and 22, were bursting at the seams. But these were not in the fiduciary interests of the actual owners of the assets, as we've now learned. As we've now learned. In the worst performing year for ESG funds was 2022, where they underperformed by almost 2,000 basis points, which is a lot. The second worst year was 2023. So we have had back-to-back really underperforming years for ESG funds relative to the broader market. So the shine is off.
Well, let me give you sort of the more cynical view of this process. So you had this extraordinary innovation of buying the whole market. And it was revolutionary in terms of its benefit to the investor. But like most great things, it had its soft underbelly. And the soft underbelly was governance. Because now you've got a situation where the largest shareholder in 40% of the companies in America are these index funds. And so they have their own incentives. Now, Terry believes, and he's entitled to his beliefs, but that there's good intentions, and I'm sure there are some good intentions, but you got to realize these funds are all selling the same product, okay? So if they get lower rates of return, so do all their competitors. And so they have an incentive to try to gain market share by claiming that you can make money with us and you can save the world with us, okay? And so there's a perverse incentive in here that I started writing about in the Wall Street Journal 6 or 7 years ago, saw this thing coming. And let me say, this idea about private capital serving public purpose has been tried. You'll remember Clinton, in his campaign for president, had this idea of using pension funds to invest in things that would promote public interest.
Infrastructure.
Yeah, and he got elected, and so he set out to do it, and even the unions that were his big supporters weren't willing to let him mug around with their pension funds. So what did he do? He went to HUD and got HUD through the GSEs to promote a policy to fund low-income housing by causing a deterioration in lending standards, and the subprime crisis grew out of it. So capital-like people can't serve two masters. It either belongs to the people it belongs to, or else it's subverted to other uses. And finally, there's no beating around the bush about it. All of this ESG movement is a complete violation of fiduciary laws. The fiduciary laws are as clear as the morning sun. The objective of the investor has to be to promote the sole interest of the people who invested the money.
Okay, so Terry, when I started out in life after college, I went to work for a bank. And the CEO of the bank,
I'm sorry to hear.
He used to come out and see us, and he'd give us a little talk, and he'd say to all the employees, there are three constituencies of our bank. There are the customers, there are investors, and there are employees. And then he would throw in the community. Say, we also have a constituency that is our community.
This was Jamie Dimon?
Yeah, that's what it could have been. But my point is, is that different than ESG? Or what's wrong with saying that we should be focused on more than just the shareholders? We should also be focused on the customers and the employees and the community.
Well, just imagine, if you would, Robert, if someone were running a company and they were saying to themselves, the only thing I care about shareholders, I don't care about my workers. I don't care about the community we're operating in.
Yeah.
I don't care what they, I mean, it's just nuts.
Yeah.
I mean, what's self-evidently the case is if you care about your shareholders, if you're caring about the profit maximization, you better damn well be looking after your employees. You better very much be thinking about the environment you're operating in. You better think about what your regulators think of you. You better think about what the broader system, you know, we had this Bud Light example recently that everybody's probably fairly aware of. So there's Bud Light. They want to actually diversify. They want to actually grow market share. What do? They have a series of commercials promoting alternative lifestyles that were directly contradictory to what most of the people who drink Bud Light do. What happened? Bud Light sales went down 25%. Bud Light sales were absolutely tanked. Now, did that person, in the effort to serve some socially wonderful cause of inclusivity, serve society well? No, not at all, particularly the shareholders. So I would just say, and Milton Friedman's famous article is actually, it needs to be more closely read and more closely studied, because he doesn't say companies are should prioritize short-term profit maximization. That's not what he says at all.
Yeah.
What he says is that they have to prioritize profits relative to both their legal requirements and societal interests. And societal interests are changing. Yeah. People actually care about things that they didn't care about. There's a Huntsman recently held up a plastic bottle. This plastic bottle probably has 1/3 the amount of plastic it had in it 3 years ago. Now, why? Did they do that for the environment? Did they do that for, well, they did it for a couple of reasons. One, it's cheaper. Two, people are actually choosing to have bottles that are somehow more sustainable. That's the winning thesis. That's the winning thesis.
Let me add one thing to that. A company is a slave to its customers. The customer's king. And you have to serve the customer to maximize profits. But the question, and look, all companies that are operating on any kind of logical basis care about the people that work for them, because if you don't care about them, they leave. And they care about their community. But the point is, in the end, who do they work for? And from Jamie Dimon to Joe Smuck at the hardware store, they work for the people that own those businesses. And their responsibility is to them.
Okay, so that's the sort of private sector issue, people putting pressure on the corporate boards and the fund managers. Now let's talk about the government. The book has a lot of descriptions of issues that are being pushed by the SEC or by members of Congress, including Senator Warren. Phil, could you just take us through either the SEC or the proposals in Congress where government is trying to put its finger on the scale pro-ESG?
The Securities Environmental Commission?
Yeah, well,
that was a joke.
Yeah, okay.
No, look, what is happening is that regulatory agencies from the SEC on out have taken it upon themselves to use their regulatory power to force private companies to serve what they deem to be the public purpose. And again, in doing so, they are in total violation of fiduciary standards. And it's getting progressively worse in the sense that even in the CHIP bill, for example, which made no mention of ESG, when the CHIP bill was implemented, it has all of these ESG requirements in it that you don't get the money unless you do that. Mm-hmm. Now, that was never written into the law. It's just a decision the regulator made, and clearly has no basis in law and violates fiduciary standards.
And just to be clear, Phil, if the policies or positions they were pushing were conservative positions, or that they wanted to force the companies to adopt.
Yeah,
You'd be
look, it
against
doesn't
that as
matter.
well.
It's whatever.
They might be.
have
They
no
might be in a
right.
year. So
Yeah, they
Yeah.
they have no right to force the companies to do anything except to abide by the law. And if Congress wants to change the law, they can change the law.
correct.
But what we're seeing now, which is pretty astonishing, is these regulatory agencies have basically taken it upon themselves to change the laws of the country. That's why the Supreme Court decision on the Exxon,
Chevron.
the Chevron
Deference.
position is so critically important.
Terry, do you want to add anything on the government intervention? And especially, there's a chapter in here about Senator Warren's Accountable Capitalism Act.
Yeah. Yeah.
And I just tell us a little bit about the threat of that, of using government. The way the chapter begins is it talks about retirees who are dependent on their 401ks to potentially support them in their old age. And the provisions of the act will be harmful to the preservation of that capital. Is that correct?
That's correct. That is correct. And I think, I think everybody in the room appreciates the allure of stakeholder capitalism, the idea that we can have an all-hands-on-deck effort to solve the greatest social and environmental challenges of our time. Elizabeth Warren's Accountable Capitalism Act effectively, though, would hardwire all these things in such a way that the number of people that are actually on the board, how decisions are being made, it completely denudes, as Phil has said, the actual capital generation role of the company. And that, it's just a movie that ends badly. It's just a movie that ends badly, Robert. Why are we messing with what has worked so well? And I oftentimes do this counterfactual. What if ESG had never been invented? What if Kofi Annan never came up with the United Nations? How different would we be? How different would the world be? I don't think business would be much different, but the debate would be much less cacophonous. We wouldn't be at each other's throats having.
And not to make this too political, but again, to ask you the question, there's now some efforts to intervene in the market from government on big tech or on Disney. Similar interventions that would be harmful to your principles. Is that correct?
No question they're harmful to the principles. And there's another chapter in the book that I know you're going to mention, which just shows from a corporate standpoint, in terms of corporate performance, companies that lean right or companies that lean left, companies that actually have a political affiliation of any type, underperform those that are studiously neutral, that are studious. And that's one of the reasons why Vanguard has been taking so much market share amongst the big three, because they didn't have a personality like Larry Fink at the helm, who was net zeroing his way around the world. And that actually ended up very much benefiting.
Yeah, I think also, just one final point on the Warren thing, is she and Bernie Sanders have actually asked companies like BlackRock to intervene through their voting power on share of money that their investors have invested in labor issues in a pro-union way. And look, there's a huge myth out there that permeates the tax debate and permeates the ESG debate, and that myth is that there are these big rich corporations. 74% of corporate America is owned by 401ks, IRAs, private and public pension funds, insurance companies to back up life insurance and annuities. You're talking about people's retirement. It's not this rich guy just doesn't exist. And as I pointed out elsewhere, if you took every penny of every billionaire that we don't already take, you couldn't fund the government in 2020, federal, state, and local level, for a week. So this rich guy out there that's going to fund everything, it's just all we got to do is take his money and everything's going to be great, is at first, He doesn't have the money. The pension funds have the money. Secondly, there's just not many of them.
Okay, so two more questions from me. The first had to do with, in the university world, sometimes we say, because of progress that's made, you may not agree with this, that we're past peak woke, that it was bad a few years ago, and maybe we're making some progress in getting some sense back into the university world. Maybe you don't agree with that. But what about here? Are we past peak ESG influence, or is it getting worse? Or how do you feel you're doing in the fight against this problem?
Well, I don't think we've killed the beast, but the beast is wounded and down.
No, that's right.
And the fact of the matter is that after 2 years of underperformance of the funds, after Larry Fink very publicly announced that he will never use the term ESG again because it's too politicized, he has yet, though, to turn his back on the $450 billion worth of ESG funds that his firm manages. But what I will say is that it's also clear in corporate resolutions, the number of shareholder resolutions are also coming down. So I think there is I would just describe it, Robert, as a return to sanity. And perhaps something that is not too surprising. We had this, at one point, ESG funds were taking in $8 billion a day. If you did not have an ESG fund and you were a fund manager, you went out and created it because you wanted to be part of the making the hay while the sun was shining. The simple fact of the matter is that there are negative flows in that market for the first time. And that there's clearly, the shine is off a lot of these diversity movements because the data is so compelling. The data is showing you that this is not an alpha generating process. Yeah, if you were short oil and gas companies, you really underperformed the last 2 years.
Yeah, I'd just add to that I think it is past its initial peak. You're beginning to have reaction to it as the data becomes clearer. The states are beginning to use their power to enforce fiduciary standards for the companies that are managing their state pension funds.
Yeah.
And so I think you've got a combination of two things happening. I think you've got people that have gotten way the hell out committed to this stuff that are now trying to back away from it. And then you've got people who are pretending they're backing away, but they're dragging their anchor.
That's right.
Yeah, okay.
So is it dead? No. Should it be dead? Yes.
Yes.
And
yeah, that's why we titled it Ending ESG.
I want to be sure we don't miss 2 points. One, we make the point in the book that, look, it is wonderful to want to do good things.
That's right.
Yeah.
But probably the most efficient way to do good things is to do well, invest your money to make money, and then take what you make and do good with it. Okay, that's the old-fashioned way, and it's the way that still works best. Secondly, there is an emerging market of what we call impact investing. And we have an old boss who's in Switzerland who's now heavily into it. And they invest in stuff like water wells for tribes in Africa, okay? They know going in that the rate of return is lower. But they're willing to take the rate of return because when you give people potable water, you change their lives.
Oh, it also could be investing in innovative nuclear power.
Yeah, and they're doing things like mini loans in South America. Yeah, so they're not changing the world, but they're changing the world of the people that get those loans. So
we're not in favor. We're in favor of a better world for everybody. Yeah, exactly. Just to be very clear.
But we want to have a better world efficiently, and we want the people to decide, not some select elite who decide, well, this is what we should be doing. People ought to decide themselves. If Warren Buffett's giving his money away, he ought to decide where it goes.
That's right.
So it covers all of the various angles and aspects of ESG in an extremely good way.
Everything you need to know
Everything you need to know about ESG is in
it's small. It's not
book.
big.
It's
It's
not
small.
But before I open up the question, is there anything that you want to make sure that you said about the volume or about the topic that I haven't covered?
I think on this impact investing, it's something that I'm now turned my full-time attention to. I mean, there are some extraordinary opportunities that you can do well and do good. I can come up with equity investments in low-income housing that return 18% a year. There are private equity funds and venture capital funds that are very focused on educational outcomes or serving the underserved broadly in the medical field that are also generating 18, 20% returns. So to me, if there is a great investment opportunity out there that is genuinely solving one of the challenges of our times, that opportunity should not lack for capital. And we make that point in the book. All in favor of greater inclusivity, all in favor of greater maternal health, all in favor of everyone advancing and everyone's inalienable rights being realized. It's just not going to happen with ESG, Robert.
Yeah, and finally, if somebody tells you that they can impose a constraint on the profit motive and that you can still achieve the same rates of return, they never took calculus. Okay, maximizing subject to constraint produces constrained results. And so, I mean, the data shows it very clearly, as Terry has talked about and wrote in the article, but it violates simple mathematics. When you impose constraints, you constrain.
And it probably was no surprise that the #1 overweight of Occidental Petroleum in 22, which was the #1 performing stock in 2022, was with Warren Buffett. So let's just say he did not have blinkers on in terms of his own
God
investment.
bless Warren Buffett.
Yeah, God bless Warren Buffett.
Okay, let's have a question. Let's see.
Do we need mics for the
Yeah,
questions?
the mic's over there.
Talk right into it, because I'm old and I can't hear too good.
Let's go right there. We've got a hand shot up very quickly.
Awesome. Thank you, Senator Gramm and Mr. Keeley. My name is Jackson Kinsella. I'm currently an intern here and rising sophomore at Stanford.
Pull it a little closer to your mouth.
This better?
Yes.
Yeah.
Awesome. Sounds good.
Fire
So
away.
my question was, what is the legislative remedy to sort of the rogue SEC policies that we're seeing? Would it come via perhaps like an amendment to Section 14? Like, I'm specifically talking about the social policy, like exclusion rule where, shareholders can, like those shareholder social policy goals can be included in, like internal decision making. How can we push back legislatively against some of these ESG policies?
Well, I think there are a lot of ways of pushing back, but I would begin by reaffirming fiduciary responsibility.
I think that's right.
I think that's the right place to start. Secondly,
But can I just interrupt you on that? Isn't that litigation? Don't you sue? They're violating the legal requirement.
It could end up at the Supreme Court,
And
for sure.
I think if Congress doesn't fix it, ultimately the Supreme Court will have an opportunity. But also, I think whether you're a Democrat or Republican, presidential elections shouldn't mean as much as they now mean. And they have taken on this overwhelming importance because the government agencies write their own law. And so if I were in the Senate, again, thank God I'm not, but if I were, I would begin to approach Democrats and say, look, why don't we try to write a general principle in the law that if Congress didn't mandate it, regulators can't do it. And so if Trump is elected, he can't do things that aren't the law that you oppose. And if Biden is elected, the young people who run the government now can't do things that aren't legal. You would think some accommodation like that would work. But now these presidential elections are like electing dictators. It's frightening to me.
Did you say it was Jason, your name? Jackson. Jackson, another thing to look at is what the House Judiciary Committee has recently done, which you've probably been following, which is that they are now actually lodging antitrust lawsuits against CalPERS and against some of the shareholder activists. So there's a way of looking at the ESG movement, antitrust, from the opposite angle. And that's something that the House Republicans are working on.
Okay, we have another question right in front of you. There you go. You got your mic.
Hi, I'm Charlie Fiore. I'm a government relations and defense policy intern here at AEI. And I was just wondering how you think the pending expiration of Trump's 2017 Tax Cuts and Jobs Act will impact the final months of the 118th Congress and the elections in November, and also what you think the future of tax policy
Much
will
more
hold
interesting than ESG.
in
So-
2025.
So this is a topic that you are
Yeah,
interested
now
in. Phil.
tell me again exactly what his question
It was,
what's the
how do you
expiring?
think the pending expiration of the Tax Cut and Jobs Act will have on Congress before the end of this session, and where do you think tax policy is going?
Well, first of all, I'm very thankful that the corporate tax rate does not expire.
Yeah, that's the most important thing
That
to
is
remember.
far and away the most important thing. And politicians talk about raising corporate rates because people don't know who pays corporate taxes. Corporate taxes are either paid by consumers, or paid by investors, or paid by workers.
Yeah, but
And
Phil,
so the best part is permanent. The other parts, I think no matter who wins the election, some of it will be extended. I think there'll be a lot of bad ideas from both parties as to how to pay for it.
Yeah.
I know the best idea, spend less money, but I don't think that will be the proposal. And don't get too frightened, because remember when the tax cut was initially proposed, a large part of it was going to be paid by the tax on imports, import substitution, or whatever it was called. We killed that.
okay, but just let me follow up on that question, Phil, since I've got you here. If there's a stalemate and the corporate tax reduction remains in place because it's permanent, and the other tax cuts get reversed, how damaging do you think that will be to growth in America?
A lot less damaging than if the corporate tax rate went up.
Okay.
And look, it will raise my taxes, so I want it to be extended. But in terms of the future of America, we have got to find a way to explain to people they're paying the corporate tax. The corporate tax is a very regressive tax. It hits the consumer, it hits the worker, and the investor's a retiree. So it's not some rich guy out there or rich woman out there is paying this stuff. And if people understood the corporate tax rate, there's no way Biden could be talking about raising it. It would be suicide. But they don't understand.
Yes, sir, right here in the front.
And I'm fine if we don't do ESG questions.
Sure. This is a little bit related to ESG, but
Yeah.
the question is the problem ESG, or is the problem the structure where businesses are being compelled and coerced through an ownership structure that doesn't necessarily have the best interest of the company at heart? You mentioned Warren Buffett. I love him. But what he does, from my understanding, is more or less shields the companies that he invests in so that they can operate more as private businesses.
That's true.
And so I worked actually, and I led efforts with dealing with things like ESG for the largest privately held company in the world. And we would do activities. For us, when we would look at CSR or ESG, it wouldn't be to come out and check boxes on things because some shareholders were coming to us because we were privately held. It would be what do we want to do for the best interest of the company? For us, that was to pay our employees more. It was to give our employees health care in an industry where that wasn't the norm, because that for us was better business. Then those would be the elements that we would talk about, because that for us was our corporate responsibility. But at the end of the day, a lot of companies face pressures with ESG that are coming from checklists. What are you doing on all these things? But they also face pressures through that structure where they might say short-term results as opposed to a long-term play for the company, which is more of what Warren Buffett has. So it's
Terry, you go ahead and go
Publicly owned
first. I've
company?
been
Well,
talking too much.
I think it's important. Appreciate the question. Your name? Will, Will, I think that it's important to reflect on why are there so many pressures on corporations to solve social problems that are either individual responsibilities or responsibilities of better public policy or responsibilities of philanthropic organization that might take those things on. And broadly speaking, it's because business is one of the few things that's still working.
That's right.
And so you're going to go after, well, this one's down on his knees, this one's down on his knees, this one is still standing, let's make them paint the side of the barn. And so I think that the real challenge that we have is that public policy and civic society. There's a great book by Rajan from the University of Chicago called the Third Pillar, where he basically talks about how societies that have the three pillars of society in balance, the corporate sector, the government sector, and the philanthropic or civic sector, those are the societies that thrive. Those are the societies that thrive. And what we're lacking in our country is not good business. We have good business. We're lacking better public policies, and I think that's where the pressure stems from.
Yeah, I think that more and more companies are going private to avoid exactly what you're talking about.
It's BS. They look at these checklists, and it's just BS.
I'm also concerned about the growing ownership structure of corporate America. Milton Friedman was very concerned about any kind of public pension funds, Social Security funds invested in the private sector because he was concerned it would get government in control of the private sector. These index funds now have become so dominant that somehow, some way, we've got to address this issue as to what is the motivation of the people who are voting somebody else's shares. And they're trying to deal with it, but I think they're trying to deal with it to get a shield up.
That's right.
Okay, I don't think they're trying to deal with a problem, but it's a very real problem that we've got to deal with. And I think the solution is, or at least if I were going to do a solution today, it would be that unless the shareholder says, I want to vote on this issue, they can't vote those shares. Mm-hmm. The aligning management with the owner is still a mega problem. And you screw around with that, and when you do, you imperil the system. And that's why I take this thing so seriously.
We need an innovation on votes and on corporate stewardship. Right now, it's very dominated by two institutions, ISS and Glass Lewis, and it's not serving the society well. That'd be another issue, Jackson, that I would look at legislatively.
Okay, right here. And then we'll take one more after this.
Okay, you pointed out the difference in the profitability of the index funds that do ESG versus ones that are keeping their mind on the owner's profits. If you extend this out many years, you can show a lot of money difference to the people who are investing. That's right.
Yeah. And look, a lot of money to people's retirement. Yeah. This isn't less money for John D. Rockefeller. This is less money for real, honest to God, flesh and blood, working people who spent a lifetime building up these funds, and stealing their earnings is fundamentally dishonest and wrong.
And maybe I can make a technical point, Robert, on why it is so hard to beat these indices. And that is because there's a great misnomer. They're referred to as passive. They are anything but passive. Indices are very, very active. They are actually updated every quarter. They are done in accordance with market.
Are you talking about EFT funds?
Anything that S&P 500.
Anything that buys the whole market.
If you take the market. So the S&P 500, Robert, 1/5 of the companies drop out of it every 3 years, because that's how it's being managed. So it's not like everything is go to sleep. These indices are themselves active. They are not passive.
Okay, let's have one right here, and then we'll call it a day.
I have.
Oh, we got one over here?
Yeah.
Well, take him and then him. Do
Okay.
both of them.
Do both of them, yes.
Yeah. No, thank you, Christian. No, first, Robert, do want to thank you. Well, it's a white male panel, but you make clear that you don't need diversity to have a good discussion. Thank you, thank you. My
like
question.
being
I'm in love with Phil. I don't know if that changes anything.
I love being reduced to my,
Okay.
No, thank you. The question is, what do you see as a smart role of the public sector, of governments, in private business?
I didn't catch it.
what is
What
the-
a smart government action in private business?
Yeah,
So it's not ESG, but what kind of role do you see for government and the public sector in private
Phil,
business?
give some
What kind of
examples.
role do I see for government
Yeah,
and private business?
where can government intervene?
Where does government regulation make sense?
Yes,
Government should enforce the law. It should protect against fraud. It should enforce contracts. It should make justice cheap. But also, it should let capital find its own market and own price. And part of the economic enlightenment was the idea that government was going to make decisions in public. They were going to have debates. They were going to cast votes. And what is happening now is government is making decisions unilaterally by somebody, a small clique of people in government, or some group of activists who get together and impose their views on everybody else. It's a total violation of the democratic process. So I think the role of government is limited.
yeah, but Phil,
But it has-
as a former member of the United States Congress, you would acknowledge that Congress has some role in not taking up these issues and letting this
I
happen to
don't-
them.
Congress is culpable in all of these things
There you go.
by not writing laws that cover very complicated and controversial issues and leaving it to the regulators to write the law.
There's also a serious public policy conversation to be had about negative externalities. So, of course, I don't think you would have voted for the Clean Air Act when it came out, but you probably would support it today. The simple fact of the matter is negative externalities, it's a public conversation. We need to have a public conversation. By the way, in the case of climate, that's a global conversation. That's not because today, 3 countries alone, India, China, and Russia, have 3.5 times the greenhouse gas emissions of the North American continent and the European Union combined. So we can kill ourselves in the United States and in Europe.
No difference at all.
And it will make no difference at all in terms of the climate.
All right, he's the last guy,
Last
the guy
question
right there.
And then I have
Probably a
I
subversive.
have one thing I
Yes,
wanted
I'm
to
probably
say.
Yes.
making a mistake.
No,
It's probably
no.
a subversive. He
No,
looks
he's
subversive.
not. Shut up, Phil.
Go ahead.
Come on.
Yeah,
Quiet
no.
down back there.
It's hopefully worth your time, I promise. Yeah, Mr. Keeley, Senator Gramm, thank you so much for the talk, and I'm really a big fan of all the work you guys do. Very quickly, so this was a conversation I had with Benji Backer. He heads the American Conservation Coalition a while back. Can you hear me well?
Yeah,
Keep
you're-
it up, keep it close.
we're getting, keep going.
Okay, so what I was saying was that a lot of times when the left attacks us on, our opposition to the Green New Deal or environmental overregulation, they'll say, we only care about money, we hate the environment, we want to see all the trees burn, right? Which I believe is not true. And so that's why I've noticed a lot of Republicans, especially some of the ones that are recently getting elected, pushing environmental policies that are more conservative and saying, look, we care about the environment, but we want to solve it in a manner that's sane. To now look at ESG in a similar way, right? As you mentioned, we do want everyone in the world to generally have a better quality of life. We
No question.
ostensibly have the same intentions as what the ESG folks claim they have. And so in terms of providing a suitable alternative to ESG that we can pitch to the American public and pitch to business owners, would you say that's impact investing, or would you say that's something else? I'm curious as to your thoughts.
So there's a chapter on this in the book, several chapters on it in the book specifically. One is entitled ESG Needs to be Replaced by Something Less Controversial than ESG. To just give it, we need to take it out of the political realm. But I am hopeful in terms of looking out a century, 2 centuries, 3 centuries. Let's remember the world has never had 10 billion inhabitants before. There were 1 billion in 1800, 2 billion in 1900, 4 billion in 1985, 8 billion in 2022. We'll peak out somewhere around 10 billion. We're going to have to figure out how we're going to live on this planet, all of us, giving everybody the opportunities that they deserve as God's children to achieve as much success as anybody else in the world. We're going to have to figure that out, and we're going to have to live ourselves. We're going to have to live in a different way to do that. I believe impact investing, which is now about $1 trillion market, will be a $10 trillion market in about 20 years, and that's what I'm really
Let me respond by saying that, first of all, Congress ought to pass environmental laws. Bureaucrats shouldn't make them up as they go.
Sure.
And they ought to be debated, and people ought to know what things cost. My guess is we'll deal with Terry's problem about the exploding population with markets.
I agree.
That's how we dealt with it before. You'll remember before the Enlightenment, everybody criticizes Malthus, but he was right.
Mm-hmm.
He was absolutely right, and for 1,000 years. Growth in population drove down wages, reduced population. It was only when freedom set the process toward growth that Malthus was invalidated. And if you threaten that growth, then you threaten everything. And that's what people don't understand.
You were going to make one more point?
Some of you may be wondering what it's like to write a book with Phil Gramm. It's the, last year his wonderful book, The Myth of American Inequality, won the Friedrich Hayek Award. I think there's a very good chance he's going to win Friedrich Hayek back-to-back with this new volume. I'll just say to you all that some of you may think of Phil as a national treasure. I do more than anybody else in the room. He is a dear friend. His heart, you don't understand how big this heart is. He is as concerned about anybody on the planet doing well as anybody who's with AOC and the squad. And it's just a very different vision of how to achieve those ends. So my dear friend, that was a real pleasure.
Terry. I don't know what you want. But I used to say when I was in the Senate, I have a heart. These were old Graham Rudman days. I was cutting things. I hated people. And I used to say, I have a heart. I keep it in a glass jar on my desk. It bleeds when I talk about cutting things. But if you don't have a heart to be concerned about the future of America, when we've got the debt problems we have today, what the hell do you have a heart for?
That's right.
And that I think as people that believe in freedom, we got to make that point.
Yeah.
Never cede the high ground to the left.
Yeah, the moral high
Never
ground.
in my political career did I ever grant them the high ground. I had the high ground. They never had it. And once we get it back, hopefully we'll keep it a while.
All right, with that, thank you, everybody.
Thank you. Thank you.